Good afternoon, guys. So, welcome to our latest trading idea video. And this one is going to be an educational video talking about the bond market and more specifically a recent inversion of the yield curve and what that means for markets and what that means for the economy. So, over the next few moments, we're going to get into that in a little bit more detail. Now, as many of you may already know, the yield curve is a measure of the difference between interest rates between short term and long term bonds. An inverted yield curve occurs when we have short term interest rates are higher than what long term interest rates are. And this can be a cause of concern because it can indicate that investors are expecting economic growth to be slow in the future. Okay, so that's where we are at the moment, and obviously that's what brings us to this chart. So you can see I've kind of tried to show on this chart exactly how it is set out and how these yield curve inversions happen. You can see the chart itself is the 10-year Treasury, the 10-year Treasury bond, and that is minus the 2-year Treasury bond. Okay, so that shows us here the yield curve inversion. Once the ratio gets above zero, then that is typically a projected expansion of the economy. Now, if it was to drop below the zero level, which we've marked out here, and get into this territory, then this is the projected recessions, okay, where projected recession will happen throughout the economy. So it's quite easy to see on this chart here, and it's always something worth watching and just kind of seeing exactly where things are in this and where the trend is. Because even though things aren't dipping below the yield curve line here of zero, so even at these levels here, you can actually get an indication of how experts and how the market is viewing the projected economy. If things are on the up, then that's typically good news for the economy. When things are on the decline, particularly when there's a sharp decline like this, as you can see, then that's typically bad for the economy, and you can actually tie these up to different moves in the stock market as well. So quite a useful indicator generally just to simply be aware of, but specifically when it drops below the zero level, then it can be even more telling. So the yield curve inversion, it has many experts worried. In the past, yield curve inversion has been an often reliable indicator for any recessions. Okay, so in fact in the last 50 years, every recession has been preceded by an inverted yield curve. You can see that here, where a few times over the history things have kind of dipped below the zero level, and every time it has done that, we've actually seen a recession come afterwards. One reason for the current inversion may be the Federal Reserve's recent interest rate hikes. The Federal Reserve has raised interest rates several times in recent years in an effort to prevent the economy from overheating. And that certainly is as well a battle against inflation more recently, and it's certainly something that you'll hear all over the news over the past number of months, and no doubt going forward into 2023 as well. How? Now, the thing is that these rate hikes have an unintended consequence of actually slowing economic growth. And that's, well, it can be an intended, but equally so, that is part of its intention. Because once the economy is starting to get too hot, or is perceived to be getting too hot, or, too overexcited, then it means that the central banks like the Federal Reserve will want to try and keep a lid on that so things don't get too much over the top, prices go too high like they have been when we get talking about inflation, as we say. So despite the potential risks, some experts believe that the current yield curve inversion may not be as concerning as it seems, though. They argue, though, that factors such as a strong job market, which we've just seen lately over the non-farms payroll report, was very, very strong. Low unemployment rate suggests that the economy is still in decent shape. We have already touched upon, though, there are situations where that is not the case, and some of our followers will be aware of another article that we've put out on that topic, which does explain some of the idiosyncrasies of that and some of the nuances of the job report, and we want to go in a little bit more detail about that. That's for another day. However, the thing to remember is that where things are at the moment, it does really just show that potentially, as the Federal Reserve is currently hiking interest rates and it continues to forecast that it will hike interest rates even further, then I think this problem will only get worse. And what it's showing you is that the market is actually thinking that the Federal Reserve has maybe got this a little bit wrong in some respects. It may be showing that they are trying to cool the economy too much and will actually force us into a recession. No way of knowing for sure, but it certainly, when it looks at probabilities, as I say, every recession over the past 50 years has been preceded by one of these inverted yield curves. So the history does suggest where we are at the moment. Okay. One thing I would say is I think that charts like this, situations like this, will certainly make the Federal Reserve think twice and potentially make them just kind of question whether or not they need to be hiking rates as far as quickly. But we'll get to know that throughout the next couple of months as Federal Reserve interest rate hikes come out and the Federal Reserve interest rate decisions come out. So thanks for listening. Of course, if there are any questions that you have, feel free to pop them into the comments below. If you have any thoughts yourself on this chart or anything that we've discussed so far, great, pop them into the comments. I'll look to try and get back to as many people as possible. But thanks very much for your time, and enjoy the rest of your day.